A country of nearly 900 million people had to pawn the physical reserves of its central bank to survive bankruptcy. The greatest humiliation of modern India happened in utmost secrecy. July 4, 1991. A heavily guarded vault in Bombay. A group of sweating officers loaded heavy boxes into armored vehicles. Not cash, but tons of solid gold that the Indian state was secretly moving out. Welcome to Plexo. The Reserve Bank of India was executing a desperate operation. The country had run out of money. Foreign exchange reserves had fallen to less than $1.2 billion. That barely covered 3 weeks of essential imports. If they didn't get dollars immediately, the nation would face a catastrophic default. The only way out was to hand over the national gold as collateral to foreign powers. Under cover of night, armored trucks loaded with pure gold bars rolled through Bombay's empty streets toward the airport. The goal: move 47 tons of precious metal to the vaults of the Bank of England and the Bank of Japan. Commercial airlines refused to carry the cargo due to high risk. The Reserve Bank had to charter flights from heavy-lift cargo airlines. It was a covert financial rescue. In exchange for pawning its physical sovereignty, India would get an emergency loan of $400 million. No one knew that wealth was crossing European airspace. When the truth came out, the financial panic turned into a national trauma that would take decades to digest. To understand how a giant fell so low, you have to look at the perfect storm of 1990. India had been living beyond its means for a decade, financing huge fiscal deficits with expensive foreign debt. Its closed, bureaucratic economic model was deeply inefficient. Then 2 geopolitical earthquakes shattered its fragile balance almost simultaneously. First, the collapse of the Soviet Union. Moscow was New Delhi's biggest trading partner and allowed trade in Indian rupees. Suddenly that shield disappeared, and Indian exports collapsed. Second, the outbreak of the Gulf War in August 1990. Iraq's invasion of Kuwait sent world oil prices soaring. India, completely dependent on foreign crude, saw its energy bill multiply overnight. The conflict also triggered a brutal humanitarian crisis. Thousands of Indian workers fled Kuwait with dusty suitcases, abandoning their jobs in the desert. That meant the sudden death of remittances, a crucial source of dollars. By early 1991, credit rating agencies downgraded Indian debt. Foreign banks cut off credit, and panicked investors pulled their deposits. In the chaos, Manmohan Singh, a soft-spoken economist with an impeccable blue turban, was called in to become finance minister. The picture he inherited was bleak. The economy was on life support, and the only way to avoid default was to submit to the IMF's harsh demands. A quiet man facing the toughest decision in his country's modern economic history. The International Monetary Fund was ready to inject liquidity, but it demanded brutal structural reforms and, above all, a tangible guarantee. That's how the plan to pawn the nation's gold was born. Before the secret flight in July, the State Bank of India had already sent 20 metric tons of gold confiscated from smugglers to the Union Bank of Switzerland. It wasn't enough. The crisis was devouring dollars at a terrifying rate. When the press leaked that another 47 metric tons were flying to London and Tokyo, public outrage was immense. In Indian culture, gold isn't just a financial asset. It's a sacred symbol of family security, status, and honor. Families measure their prosperity in jewelry, and seeing the government pawn the central bank's gold was like selling grandma's heirlooms to pay off gambling debts. The image was devastating. Bars of Indian gold, stamped with the country's emblems, ended up stacked in the cold vaults of the Bank of England, under the custody of British bankers. For a nation that had fought for decades against colonial rule by the British Empire, that scene represented a bitter return to economic submission. Yet this deep public humiliation had an unexpected effect. It broke the political paralysis. The scandal forced the entire ruling class to grasp the extreme gravity of the situation. There was no more room for endless ideological debates or protecting state monopolies. The country had hit rock bottom. The only direction left was a radical change in the rules of the game, and shame, paradoxically, became the fuel for transformation. On July 24, 1991, Manmohan Singh stood up in Parliament to present the most important budget in independent India's history. His speech wasn't just a financial statement, it was the death certificate of the old economic model. Quoting Victor Hugo, Singh declared to a stunned audience that no force on earth can stop an idea whose time has come. That idea was total liberalization. Within days, the government enacted reforms that would have seemed unthinkable months earlier. The Indian rupee was devalued by 20% to make exports more competitive and stem capital flight. But the masterstroke was dismantling the dreaded license Raj, the bureaucratic maze that suffocated private enterprise. For decades, any Indian entrepreneur needed dozens of government permits just to open a factory or increase production. Corruption and slowness were the norm. With the new policy, piles of industrial permits stamped in red ink were thrown into the trash in New Delhi. Restrictions on foreign investment were lifted, allowing international capital to flow into previously closed sectors. Import tariffs, which exceeded 80%, were slashed dramatically. The state ceased to be the sole economic actor and opened the doors to global competition. These shock measures, designed under the suffocating pressure of the IMF, turned the pain of the bailout into a resuscitation therapy. India not only survived the collapse, but used its ashes as a foundation. The impact of the 1991 reforms was as fast as it was spectacular. Devaluation boosted exports, and market opening triggered a flood of foreign investment. International confidence returned at an astonishing speed. By November 1991, just months after the humiliating covert bailout, the Indian government had accumulated enough dollars to pay off its emergency debt. The gold was bought back on the books before the year ended. But the physical bars didn't return to India then. They stayed stored in the Bank of England's vaults for security reasons for over 3 decades. Then, in May 2024, 100 metric tons of gold were repatriated to Mumbai. That traumatic episode vaccinated political leaders against fiscal irresponsibility. They would never again let the country run out of foreign currency. Since that fateful summer, India's economy has grown non-stop, multiplying in size and lifting hundreds of millions out of extreme poverty. Foreign reserves, which in 1991 barely touched $1.2 billion, now exceed $600 billion, forming an impenetrable financial shield. The gold that once flew secretly to London now rests in Mumbai, a silent reminder of the fragility of power. The crisis showed that sovereignty is defended, not just by armies, but by solid balance sheets. India pawned its gold, and discovered that humiliation wasn't the price of failure, it was the payment to stop being a beggar sitting on a treasure.